As a first-time home buyer, there's going to be a lot of information thrown at you that you're expected to understand. However, do you really understand it? A good amount of that information is found on one of the documents that you'll receive from the lender once you go under contract on a home. This document is the loan estimate, which shows you all of the details of your new mortgage, including an itemized breakdown of the costs associated with your home purchase. The problem with the loan estimate is that it's 3 pages full of numbers and can easily be information overload. So where do you begin? Brand the Mortgage Man here, and today I'm going to provide you with the information necessary to make an informed decision when it comes to reviewing your mortgage documents, specifically the loan estimate. I've helped more than 10,000 home buyers over my 20+ year career, putting me in the top 1% of loan originators nationwide. And whether you're a seasoned home buyer or this is your first time buying, the amount of documentation and information you're expected to review and understand can be overwhelming. In this video, I'm going to walk you through all pages of the loan estimate, section by section, fee by fee, to make sure you truly understand what you're looking at when reviewing it. Let's get into it. So this is a loan estimate. Loan estimate, as I said, is a document that's going to break down all the terms of the mortgage that you're obtaining, and it's also going to show you all the costs you're going to incur when buying the property. So where do you start when you're reviewing a loan estimate? Well, naturally, like any document or anything you're going to review, you'll want to start at the top. What you're going to see at the top of a loan estimate is going to be the date it was issued. Of course, you want to make sure that matches up to the current date that you're reviewing it. Make sure your name is spelled properly, that you're the applicant on the document. The property address that you're purchasing should be listed. Now, underneath your name as the applicant, it should have your current address, not the subject property. But just below that, you'll see property, and that's where the subject property, meaning the home you're purchasing, that address should be listed. Make sure it's the home that you're under contract for. Under that is the sale price, the amount you're paying for the property you're buying. Now, on top to the right, the loan term. Make sure the loan term listed is the type of loan that you've agreed to get. So in this case, it's a 30-year mortgage, but it may be a 20, it may be a 15. Make sure that matches what you're expecting. Next is the purpose. It's a purchase in this case. You're buying a property. Product, fixed rate. Make sure that if you're expecting a fixed rate mortgage, it doesn't list that it's an adjustable rate or a variable rate mortgage in that section. Loan type, conventional, FHA, VA. Make sure the box is checked next to the type of mortgage you are expecting. In this example, it's a VA mortgage. Below that, you're going to have rate lock, either no or yes. So what does it mean to lock an interest rate? First off, that's important to know. Your interest rate being locked means that the lender has essentially held that interest rate for you up until your closing date. So let's just say you were expecting, in this case, a 5.749% interest rate. If the box next to rate lock is marked no, well, you're not guaranteed that interest rate. However, in this case, if it's marked yes, which is where you really want to see it marked, you want to see it's marked yes because that means you're getting the rate that's showing on this disclosure. But there are lenders out there that will send you a loan estimate with a rate that's not locked, which means they're not bound to giving you that interest rate. So keep that in mind. Now, assuming it is locked, you want to make sure that it's locked through your closing date. If you notice, it says yes until 10/31/2024 in this example. Well, the closing for this particular buyer is prior to October 31st, 2024. So their rate lock is good beyond their closing date. You want to make sure that if your rate is locked, it's locked through your closing date at a minimum. Now, come down to the next section, which is loan terms. This is where you see your loan amount. In this case, it's $858,060. But you see the word no next to that. Well, at the top of the column where it says no, it says, can this amount increase after closing? When it says no next to your loan amount, what it means is the balance is going to go down as you make monthly payments. It's not going to go up. And you might say to yourself, well, how could it ever go up? Well, there were loans in the past, you don't really see them now, that were known as negatively amortizing. A mortgage that's negatively amortizing means that rather than the balance going down as you make payments, the balance actually increases. And the reason it does that is because those types of loans, and as I said, they don't really exist anymore, but those types of loans allowed you to pay less than what the true interest rate was on the mortgage. And because you were doing that, that difference in what you're paying and what the interest rate was would be tacked onto the balance every month, meaning the balance could go up. But you want to make sure sure that if you're getting a conventional mortgage, an FHA mortgage, or a VA mortgage, that the word no is listed there. Next, your interest rate. So in this case, it's 5.749%. Now, obviously everyone's rate is going to be different. It's going to be dependent upon what you actually qualify for. But what most important is that you want to make sure that the rate that's listed on this loan estimate is the rate that you agree to with your lender. And next to that, the word no indicates that it's a fixed rate mortgage, as we already saw at the top of the page. If it said yes, which that the rate can go up, well, that would indicate it's a variable rate mortgage, right? The rate can change, it can increase. I mean, it can also go down in those cases, but what most people are concerned with as a consumer is, can that go up? If it went down, I'm sure you'd be happy. Below that is your monthly principal and interest payment. Now, this doesn't include taxes, doesn't include insurance, doesn't include mortgage insurance. This is strictly principal and interest. In this case, it's $5,006.86. Can this increase? Once again, no, it cannot increase because it's a fixed rate mortgage. Therefore, the principal and interest portion of the payment will never increase. Just below that, you have a section for prepayment penalty. It's got no. A prepayment penalty, which conventional FHA and VA loans should not have, but a prepayment penalty means that you'd be penalized for paying a lump sum toward the balance on the mortgage at any time, or paying the loan off early, or if you were in a position to be able to do that. Balloon payment, also no. What a balloon payment means is that you make your monthly payments on the mortgage. Let's just say you had a mortgage that's based on a 30-year term, so you're making your monthly payments, but the entire balance is really due after only 10 years. Well, if you've been making a 30-year payment and you get to year 10, your balance is not paid off, but you actually have to pay a lump sum to get that balance paid off. That would be a balloon payment. It means a large payment at the end of the term that pays your loan off in full. But this only happens in situations where you're paying less than the fully amortized payment, meaning less than the term in which it's due. In this case, and you typically don't want a balloon payment, in this case, it is not a balloon mortgage, therefore there's no balloon payment due. Now, below that are your projected payments. Now, this top section where it's got principal and interest, mortgage insurance, and then estimated escrow, this top section is where estimated total monthly payment comes from. So in this case, we have $5,006.86 per month for principal and interest. There's no mortgage insurance on this loan because it's a VA loan. VA loans don't have mortgage insurance. And then you have estimated escrow, $1,473. You add the $5,686 to the $1,473, and you get $6,480. That's your principal, interest, and mortgage insurance payment, if you had any, plus taxes and insurance. Now, the next section below that, estimated taxes, insurance, and assessments, $1,560. Now, this section of the loan estimate tends to be the most confusing for a home buyer. Most home buyers, when they're reviewing this document, think that they need to add the $1,560 to the $6,480 in this particular example, but that's not the case. What the $1,560 represents are the property taxes, the homeowner's insurance, and any homeowner's association fee that might be on the property, of course, only if there is a homeowner's association fee for the specific property you're buying. In this case, there is. So we said just above that the estimated escrow is $1,473, but we see $1,560 below that. That's because this property has an HOA fee. That's why those numbers are different. You don't add the $1,560 onto the $6,480, but you would add the homeowners association fee on top of the $6,480 in this example to determine what the total housing payment is. But the reason that that's not listed there or not included in the number above, included in the $6,480, is because homeowners association fees are never escrowed. You always pay that directly to the homeowners association if you have one, either monthly or quarterly or annually, depending on how they collect that fee. Now, just below that section are your costs at closing. So the first box, your estimated closing costs, in this case, $39,977, which it breaks down what that is to the right. And we'll get into that on page 2 where it itemizes everything. And then estimated cash to close, $17,503. Most people look at this and say, wow, how do I need less money to close than what my closing costs are? And that's a great question. And it doesn't always look like this. So I'm going to show you how this number comes to be on the second page of this document. So the second page of the loan estimate is going to break down the costs that you're going to incur with the home buying process, as I had mentioned. So at the top, you see it says closing cost details. Now this is broken up into sections to make it easier for you to understand. So I'm going to go through what those sections are, and I'll go back through and we'll look at how everything itemizes out within those sections. So section A, origination charges. Those are charges that come from the lender that you're working with, the bank, whomever that may be. Section B, services you cannot shop for. Those are services that I typically call miscellaneous third-party services. They're required for the transaction, but you're not getting to pick who's doing it, like an appraisal, the credit report that has to be ordered. In this case, there's a VA funding fee because it's a VA mortgage. Box C are services you can shop for. So those are typically to be your title-related charges. Now, depending on where you're buying your property, you may not be the one selecting the title company because the seller is. In that case, they're paying for the title insurance. And I'll show you how that works on this specific transaction because that's actually the case. Box D is when you add A through C up, you come up with the figure in box D. Now, on the right side, top column, E, taxes and government fees. Now, this is a Florida loan estimate. I just want to say that. Fees are going to vary depending on where you're buying your property. But here in Florida, we have transfer taxes. Anytime you get a mortgage, there's a tax that's paid to the state, there's a tax in county, and there's a tax that's paid to the city. Combined, those are 0.55% of whatever the amount being borrowed is. So this transfer tax figure, that's where that comes from. And there's a recording fee. Prepaids are going to be things you paid in advance, such as insurance and interest on the new mortgage. Initial escrow payment at closing, box G, are once again where taxes and insurance will be collected from you. And then other, box H, are other services that need to be provided, such as the property survey, in this case, owner's title policy. And once again, I'll get into a little more detail on that. So let's go back to box A, right? On the top left-hand corner, box A, origination charges. These are things that are being charged by the lender or the bank. Something I want to tell you is maybe you're using your loan estimate to compare lenders. And when you're doing that, box A is the box you really want to be looking at because these other boxes really should be the same from lender to lender or bank to bank, regardless of what's disclosed to you up front. Because as I had mentioned, those are all third-party costs. They're not determined by the lender. They're going to be the same, right? So especially if you're not picking the title company, or even if you are, the cost of title should be the same, the government charges will be the same, the escrow, so on and so forth will be the same. So when comparing lenders, this is the box A, that you want to look at. So to get back to this, in this case, origination charges, this borrower is paying 0.25% in points, right? And I've talked about what points are in other videos and how you can pay those in order to get a reduced interest rate from where the market rate is. So check that video out to get a little more detail on what points are. Processing fee and underwriting fee, right? Processing is what a lender will charge to handle the paperwork for the loan, actually collect documents from you, get it all through underwriting. The underwriting fee is the actual process of reviewing those documents and having an underwriter, who's the credit decision maker on a mortgage, actually make a final decision on the approval or denial of your mortgage. Now, box B, services you cannot shop for. Right, we talked about an appraisal fee. Appraisal is to determine the value of the property, right? A lender is going to want to know that what you're paying for a property is what it's actually worth. So they order an appraisal and the appraisal takes place, and an appraiser will determine what the value of the property is based on the market. You want that number to be equal to or greater than whatever your contract price is. You're going to have a credit report. Lender's going to pull your credit and they're going to charge you for a copy of that credit report that was obtained in order to qualify you for a mortgage. And there's all different fees. So some of the big ones that stick out here, VA funding fee. So because this is a VA mortgage, this loan has a VA funding fee. That's a fee that's charged by the Department of Veterans Affairs on all VA mortgages unless you're exempt from the fee because you have a service-related or service-connected disability. In this case, the borrower does not. So they have an $18,000 fee on top of their other costs in this mortgage. In this case, and on VA loans, you have the ability to finance that VA funding fee. So technically, you're not coming out of pocket for that money, but it is going to increase the amount of your loan balance because it's rolled into the loan. But if you remember, I mentioned on the first page, why were the closing costs higher than the amount needed at closing? And that's the reason why. So in this case, the borrower decided they want to roll that VA funding fee into their mortgage balance, and therefore that $18,000 funding fee is subtracted from that larger closing cost figure that we saw on the first page, which was $39,000 and change. And that reduces the amount needed at closing. Now, the next section, box C, services you can shop for. So VA loans require a pest inspection. Some lenders are going to require you to provide your home inspection to them for the loan. However, I know we do not, and most do not. Some banks do. But on VA loans specifically, you do need to have a pest inspection, more specifically a wood-destroying organism inspection, so termites, and that's a requirement, so that's where that charge will show. This is also where your title-related fees are. So you're going to be required to carry title insurance on your property when you purchase a property using a mortgage. Title insurance is going to protect the lender, in this case, the lender title policy, right? $4,414. You can see it there. It's the fifth item down in this box. Lender title policy is going to protect the lender from any sort of encumbrances on title that may arise. So a title company is going to look for clear title, make sure there's no liens on the property at the time that you're closing. However, maybe something got missed. You never know. And something comes up 2 years later, turns out there was a private mortgage against the previous owner, and there truly was a lien against the property that was missed by the title company. Well, the title insurance, in this case, the lender title insurance policy, is going to protect the lender from having to pay that lien. The insurance policy pays that lien. Now, you add everything in boxes A, B, and C together, and you get that figure in box D. In this case, it's $28,856. Now, let's move to the top of the second column on the right side. We're in box E. So these were government-related charges. So you're going to pay a recording fee when you get a mortgage and you buy a property, because a copy of that mortgage and the deed need to be recorded in the county where you're purchasing to show you are now the owner of the property, and that mortgage note becomes public record. Transfer taxes, as I mentioned, in Florida, we have taxes that are equal to 0.55% of the loan amount. So anytime you get a mortgage in the state of Florida, you're going to pay 0.55% of whatever you're borrowing in these stamps. The seller on the property, or you as the buyer, if you're buying new construction or a bank-owned property, maybe you bought a foreclosure and it's owned by the bank, there's another transfer tax you'll have to pay. In Florida, it's the deed transfer tax, and that's equal to 0.7% of the sale price. So it's pretty hefty. It doesn't show in this transaction because this buyer's not having to pay that. They're buying from an individual, but something to keep in mind, if you were to buy a bank-owned property or new construction, the cost of that deed transfer tax is passed along to you as the buyer, where it's traditionally paid by a seller if you're buying from an individual. Box F, prepaid items. So prepaid items are things that are paid in advance in full, right? So at closing, you need insurance in place on the property. So if you'll see, it says homeowner's insurance premium, 12 months, $2,400. So at closing, you're going to pay your first year's homeowner's insurance premium in full. Let's just say that you're closing October 31st, 2024. You're going to pay that first year at closing, which covers you up until October 31st, 2025, right? So that's what you're paying for. You have full coverage in place when you close on the property, so you're covered from the moment you move into the property. On top of that, you see it says prepaid interest, and in this case, it's $135.50 per day for 1 day. This person, as I said, is closing on October 31st, so their interest is $135 a day. Now, you might say, why am I paying interest on a mortgage that I'm just obtaining? So the way mortgages work is the interest is actually collected in arrears, meaning it's collected after the month in which the interest was actually incurred. The interest for the month of October would have normally been made or paid when the November mortgage payment is made. But when you close on a property and you get a mortgage, your first mortgage payment is actually not going to be due in the month immediately following your closing. It's due a month after that. So in this case, we're closing October 31st. The first mortgage payment is due December 1st. And because there's no November payment being made that would have covered the interest for October, that 1 day of interest is actually being collected at closing from the borrower. Like I said, you're going to skip the month after you close on the property. Next, we come to box G, your initial escrow payment at closing. In this section, it's got homeowner's insurance and property taxes. Now, a common question that comes up is, why am I putting 3 months of homeowner's insurance into an escrow account if I'm already paying the year in advance at closing? And that's a great question. So what's actually happening here is you're putting a 2-month cushion, and that's going to go toward next year's insurance premium. As I mentioned, this policy that you're paying in full at closing covers you through October 31st of 2025 in this example. But come October 31st, 2025, you're going to have to pay a new premium in full that covers you to October 31st of 2026. You're putting a 2-month cushion in escrow with the lender, plus you're putting a 3rd month, which is the month of November that I just mentioned, you're not going to make a mortgage payment in. You'll continue making mortgage payments starting December 1st, and part of that payment will be for insurance getting collected into the escrow account. You're going to have a 2-month cushion in there, plus the 12 months you collect starting in December, because you don't know what the insurance premium is going to be come October of 2025. So lenders want to make sure that, if anything, they've over collected in your escrow account over that year leading up to it. So if there is an overage, they can just refund it to you. But if the policy premium does increase, there's going to be enough money, or should be enough money, to cover what that new premium is. Now, property taxes will also be collected from you at closing. So right now in Florida, lenders are going to pay property tax bills in November because that's the earliest we can pay in order to get a 4% discount. The seller in this case is actually going to pay the property taxes in full at the time they close. So the borrower is only going to put 2 months of property taxes into their escrow account. And then once again, starting with their December payment, they'll start making payments into that account. So that way, come next November, there's enough money in their escrow account to pay the tax bill for 2025. Now, we come down to section H, other. So in this section, there's a property survey listed. It's something that's required here in Florida in order to provide specific endorsements to the title insurance policy that are required. And then it also, you can see, it says owner's title policy optional. Now, we talked about a lender's title policy being required because the lender needs that protection when they're providing financing on a property. And this was against any encumbrances or liens on title that weren't caught at the time of closing. You as the owner really should have an owner's title policy. It will do the same exact thing for you that the lender policy does for the lender, but it's going to protect you for as long as you're the owner of the property. So it's a one-time cost. And if you notice, here in Florida, that cost is $25. And the reason it's $25 is because when you get a lender policy that's required and an owner policy is issued simultaneously, you get a discount on the simultaneously issued policy. And because the owner's policy is not a requirement, you get the discount on that policy. We add up E, F, G, and H, right, which are these sections on the right-hand side that we just walked through, and that's $11,121. We add I, which is where I was just referencing, the $11,121, to D, which is $28,856, and that's where we get the total that was on page 1 of $39,977. Now, like I said, if we look at the bottom right corner, in this case, this borrower is financing that VA funding fee that's part of that total of $39,977. So you'll see there's a negative $18,060. That's the VA funding fee that matches the number in box B for VA funding fee that's being financed. So that gets subtracted off of those closing costs because it's being financed in. On top of that, you'll notice something called adjustments and other credits, negative $4,414. That number is exactly the same as the title premium for lender's coverage in box C. So as I started to mention, in this particular purchase transaction, the seller selected the title company. And because they did that, they are paying for the title insurance policy. So that 4,014, that negative number in the bottom right corner, is the credit from the seller to cover the title insurance policy that's referenced or listed in box C. But you might see other types of credits listed there, or you might see a positive number listed there, depending on your scenario. You want to keep an eye on that figure. The bottom line, after you take the total costs of all these sections added together, subtract the VA funding fee on this example that's being financed, and then subtract the credit from the seller for the title insurance policy, leaves $17,503, which matches the estimated cash to close figure on the bottom of page 1, right? So that's how you come to that number. Page 2 is extremely important when it comes to understanding all the costs you're going to incur with buying the property. Now, let's go to page 3 of the loan estimate. Now, this is where it does some comparisons for you. For one, it's going to show you the amount of interest you're going to pay in the first 5 years that you're going to have the mortgage. Now, this is a 30-year mortgage. A 30-year mortgage is the most expensive mortgage that anyone can ever obtain because you're paying interest for 360 months. And if you watch my other videos where I've broken down the amount you're going to pay over 30 years, it's really eye-opening. In this example, it's going to show you how much you're actually going to pay in total within 5 years and how much of that total is actually going to go toward paying down the balance or the principal on your mortgage. So in this case, in 5 years, you will have paid $329,403 total payments, of which $62,115 has actually gone toward the principal. A 30-year mortgage is extremely interest heavy in the first 10 to 12 years, as you can see, right? Because $260,000 of what was paid went toward interest. $62,000 of that went toward paying the balance down. Pretty crazy. Next is your APR, your annual percentage rate. As you can see here, it's higher than the interest rate, but I want you to read what it says next to that. These are your costs over the loan term expressed as a rate. This is not your interest rate. Now, what it's saying is there are certain costs that are considered APR related costs. such as discount points, lender charges. This is a good way to indicate what the costs are when you're comparing lender to lender. Who's a cheaper option to go with, right? Because the APR, if it's lower with one lender than the other, should indicate that the lender who has a lower APR is giving you a less expensive lending option. But some of the things that are factored in, like I said, are discount points. If a loan has mortgage insurance, that's factored in there. So you want to keep all those things in mind. An FHA mortgage, for example, the difference between the interest rate and the APR is going to be more substantial because of the extra costs that come along with FHA financing. So if you're considering an FHA mortgage, check out my video specifically on FHA mortgages where I break down every detail, including the additional costs that come along with FHA financing. Next is your total interest percentage. This is the amount of interest you'll pay over the loan term as a percentage of the loan amount. So if you want to determine how much interest you're going to pay in dollars, you would take your loan amount and multiply it by 110.079 in this case, and it's going to give you a dollar amount. That dollar amount represents the amount of interest you're paying over the 30 years, and it's going to be a lot. Other considerations, appraisal. Most loans are going to require an appraisal. Now, in some cases, conventional mortgages where they have an appraisal waiver may not. But what this is letting you know is that an appraisal may be required. And as I mentioned, an appraisal is going to determine what the value of the property is. Your purchase contract doesn't determine that. It's recent sales of similar homes in the area that will determine what the true value of your property is. Assumption. Some loans are going to be assumable. An assumable mortgage is a mortgage that someone else can take over from you if they qualify for the terms. The benefit is that maybe you have a lower interest rate than what that person can get in today's market, and they want to assume your mortgage from you. This is something we hear a lot about right now because there are people who have interest rates in the 2s and the 3s, and maybe they do have an assumable mortgage. So it makes their property that they're selling a little more attractive to buyers if that buyer is able to assume the mortgage from them at a 3% instead of maybe getting a 6% that they qualify for in today's market. Homeowners insurance. Any mortgage is going to require that you have homeowners insurance. This is insurance that protects against wind, storm damage, fire, flood, things of that nature, right? This is something that a lender is going to require. As long as you have a mortgage on a property, you will be required to carry insurance on that property. I'm talking about homeowners insurance. This isn't mortgage insurance that I'm referencing. Next, late payments. If your payment is made after the 15th of the month, you're going to incur a late fee on the payment. In this case, VA loan, it's 4%, right? So if your payment was $2,000, you take 4% of that, it's $50. That's what your late fee would be. It's not anything crazy, but you want to pay before the 15th of the month. If you have to pay after the 15th, just make sure you pay before the last day of the month, because if you go into the following month without making your payment, it's going to be reported late to the credit bureaus, which is something you do not want. However, if you pay after the 15th but before the end of the month, it's not late in the eyes of the creditors, or sorry, the credit bureaus. It's only late in the eyes of the lender for the purpose of charging you a late fee for making that payment. Refinancing. So letting you know that you may be able to refinance if you're eligible, if and when the time comes. This is something that's popular right now because there are a lot of buyers who got interest rates in the mid 7s, high 7s, in late 2023, and now they want to take advantage of lower interest rates where they can save over a full % on their mortgage. If you are that person and you want to know more about refinancing, check out my videos on refinancing. I'll explain how they work and when it makes sense to refinance. Servicing. In this case, it says we intend to transfer the servicing of the loan. All that means is we're not going to collect the monthly payments. And it's common in the mortgage industry that loan servicing is transferred, even in a lot of cases before the first payment is even due. This isn't going to affect the terms of your loan, as I mentioned. It's really only who's going to be collecting the payments from you that changes. So don't get scared if you get a letter letting you know that your loan servicing has been transferred. Although the loan estimate may be confusing, it becomes much easier to understand when you break it down into sections, as I've done in this video. If you found this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.